Good afternoon, everyone. I am Dr. K. Kaleeswari, Assistant Professor, Department of Commerce with Computer Applications. Today, I want to discuss amalgamation, absorption, external reconstruction, and purchase consideration. Amalgamation meaning: when two or more existing companies combine together to form a new company, it is amalgamation. All the combining companies are liquidated. A new company is floated to take over their business. Example: India's Maruti Motors joined forces with Japan's Suzuki. They formed a new amalgamated company called Maruti Suzuki Limited. One more example: Satyam Computers and Tech Mahindra Limited amalgamated to form Mahindra Satyam. Then absorption meaning: when one existing company acquires the business of another existing company is known as absorption. The companies whose business is taken over or liquidated, no new company is formed. Here is an example to help you understand the difference. A Limited and B Limited merged to form AB Limited. Amalgamation, as its name suggests, is nothing but two companies becoming one. It is nothing but two companies becoming one. Here is an example which will clarify the difference. A Limited and B Limited joined to form AB Limited. It is known as amalgamation. In absorption, B Limited takes over the business of A Limited. So A Limited loses its existence and only B Limited exists. It is known as absorption. In this process, a smaller existing company is overpowered by an existing larger company. No new company is formed. Real life example: Vodafone Limited absorbed H Limited. Then it is called Vodafone Limited. External reconstruction. When an existing company is liquidated and a new company is formed with the same shareholders to take over its business, it is external reconstruction. Sick companies with accumulated losses usually undergo such reconstruction. So under external reconstruction, when a company is suffering losses for the past several years and facing financial crisis, the company hand sells its excess business to another newly formed company. Actually, the new company is formed to take over the assets and liabilities of the old company. This process is called external reconstruction. So amalgamation is one of the tools that can help companies avoid competition among them and add to the market offerings. It is for the mutual advantage of the purchasing and selling companies. It serves as an apt method of corporate restructuring to bring about a change for the better and make business environment competitive. The main advantages of amalgamations are: competition between the companies gets eliminated, then research and development facilities are increased. Next advantage: the operating cost can be reduced. Then stability in the prices of goods is maintained. The next topic: purchase consideration. Purchase consideration refers to the payment made by the transferee company to the transfer company for the business taken over. Purchase consideration can be defined as aggregate of the shares and other securities issued and the payment made in the form of cash or other assets by the transferee company to the shareholders of the transfer company. Purchase consideration is the price. It is a price paid by the purchasing company to the shareholders of the selling company. So purchase consideration refers to the payment made by the transferee company to the transferor company for the business taken over. It includes all types of payments made in the form of shares, securities, bonds or cash. So purchase consideration doesn't include payment to debenture holders or any other outside liabilities which are taken over and discharged by transferee company. Then what is transferor and transferee company? Transfer company means the company which is amalgamated into another company, that is selling company. Then transferee company. Transferee company means the company into which a transfer company is amalgamated, that is purchasing company. Computation of purchase consideration. The purchase consideration can be computed under any of the four methods. lump sum method, net payment method, net assets method, intrinsic value method. All the above four methods, consideration payable to shareholders alone should be shown as per Accounting Standard 14. Amount payable to other claimants like debenture holders, creditors should not form part of purchase price, even if purchasing company agrees to pay for their settlement. Lump sum method. Under this method, purchase consideration will be paid in lump sum as per the valuation of purchasing company's valuation. Example, A Limited takes over the business of B Limited for rupees 15 lakh. A Limited is called as purchasing company, then B Limited is called selling company. Here, the sum of rupees 15 lakh is the purchase consideration. No calculations are needed. The whole amount paid by the purchasing company is considered as purchase consideration. Next, net payment method. Under this method, the payment of purchase consideration is made in the form of securities or cash. As per this method, the payments to the debenture holders are not included in the purchase consideration. Example, X Limited agreed to take over the business of Y Limited. The liabilities of Y Limited include rupees 5 lakh debentures. The Y Limited has capital divided into 2000 shares of rupees 10 each. X Limited agreed to pay by issuing 1000 shares of rupees 15 each and the balance by cash. In this case, X Limited is called purchasing company, then Y Limited selling company. Y Limited has 20,000 capital. The purchase consideration will be calculated as follows. Net payment method. Shares issued by the purchasing company, 1000 shares into 15 rupees per share. Total 15,000. Cash paid by the purchasing company, 5,000. The total consideration will be 20,000. The net assets method. As per this method, the purchase consideration is calculated by finding out the difference between the assets and liabilities of the company. The sum of the liabilities is deducted out of the sum of assets to find out the purchase consideration. Formula for net assets method. It is also known as net worth method. Net assets equal to agreed value of assets taken over minus agreed value of liabilities taken over. Example, X Limited agrees to take over the Y Limited, which has following assets and liabilities. Fixed assets 6,50,000, current assets 1,40,000, goodwill 10,000, debentures 1 lakh, current liabilities 1 lakh. As per this method, the purchase consideration will be calculated as follows. Fixed asset 6,50,000, current asset 1,40,000, goodwill 10,000. The total assets taken by the purchasing company 8 lakh. Then liabilities, debenture 1 lakh, current liabilities 1 lakh, total liabilities 2 lakh. The purchase consideration will be 6 lakh. Under this method, all the assets agreed to be taken over by the transferring company includes the cash and bank balances. The assets like goodwill and prepaid expenses are also included in the assets to be taken over by the purchasing company. The liabilities taken over by the transferring company, that is purchasing company, includes all third-party liabilities. The accumulated profit and reserve of selling company never form the part of the purchase consideration. Then intrinsic value method. This method is also known as share exchange method. Under this method, purchase consideration is ascertained on the basis of the ratio in which the shares of the purchasing company are exchanged with those of the selling company. The intrinsic value can be calculated as follows. Net assets available to the equity shareholders divided by number of equity shares. Here is an example. In exchange of 50 shares of selling company, 100 shares of purchasing company is available, then every 1 share in the selling company, 2 shares in the purchasing company is available. Therefore, the ratio is 1:2. In this case, purchasing company issued 2 shares for every 1 shares in the selling company. Thank you.